The bulls were able to hold the breakout support level as we go into CPI data next week. So it's going to be a very volatile week, and it's going to be very important to understand the critical support and resistance zones. So first up, let's take a look at a weekly chart of SPY. So let's crack open this chart and see what's going on in the stock market today. Alright, so starting out on the weekly chart of SPY, you can see the bulls did hold the bullish breakout after we had the bullish pivot from the support at SPY 380. And we did get the confirmed breakout now for 2 weeks in a row, which is this level above SPY 407. Now it needs to be said that this is an objective bull trend of higher lows and higher highs, and there are still people out there saying that this is a bear market and there's only one direction the market can move, and that's lower. And I'm telling you, that is a very dangerous trap to fall into. Remember, I tell you we do objective analysis on this channel, which means while I can give you my opinions, I always tell you what to watch for in both directions. And it's very dangerous to ever think the market will only move in one direction, because the market does not have to be rational. Even if we were in a deep dark recession in a bear market, it is still possible to get face ripping rallies. So please heed my warning that if you're getting too bearish and thinking we have to crash from here, or you're still believing that we can't go higher, you need to back up and you need to look at this chart, and you need to understand this is a weekly bull trend, which is a very powerful trend. If you just go back and you look at all of this bear market, this was all weekly lower highs and lower lows, and we were getting very powerful thrusts to the downside. And what this now is starting to look like is a giant double bottom off of the June lows, where it looked like the bear market was over in August. We came back down and retested the June low in October and got another successful bounce into a bull trend. And this is exactly what is called a W-shaped bottom, which is a very bullish pattern. So if you just zoom out and look at this weekly chart, this is going to look like a giant W shape if we go back into a bull market. And so far with the weekly bull trend, this does look like a possibility. And while I can't explain why it would go back into a bull market, I strictly warn you that technicals will tell you you're in a bull market way before any of the news will. So while we don't know why we're going back into a bull market, without a doubt, this is a bull trend, which means there is a very good chance we continue to climb higher, because the path of least resistance in a bull trend is higher. If you just think about it for 1 second, if the bears were strong, why were they unable to close the weekly candle below the support breakout at SPY 407? Strong bears in a bear market would have blasted right through that level, and we would already be down here at SPY 390 or lower. And that is just not what we're seeing in the price action. We had lower volume, we closed right on top of weekly support, and from here it looks like there's a very good chance SPY is going to bounce off this level and start climbing towards 427. So please be objective. You can manage your risk right here at the breakout zone, which is SPY 407, and on the daily chart I'm going to give you more risk levels as well. But you need to consider being bullish while we are above the support levels in the bull trend. It's okay to have a fundamental bear bias, but if you are trading this chart is currently in a bull trend, and you are going to continue to be on the wrong side of the trade if you don't stay objective. Alright, moving over to the daily chart of SPY. Again, you want to watch this critical support zone between SPY 407 and the support trend line at 404, which is also our rising 20 daily moving average. If you look at this chart, this is still a very powerful bull trend, and all of these moving averages are still supporting the buyers, and we do have the golden cross of the 50 daily moving average crossing back over the 200. So there is a ton of support for the bulls, but the critical risk level I want you to pay attention to is right here at SPY 404. And if we break below 404, then there is going to be a good chance we do come back down to that 200 daily moving average, which is right around SPY 393. So just manage your risk and understand, while we are above this 200 daily moving average, with all of these moving averages crossing over to now support the buyers, this is no longer looking like bear market behavior. We need to lose all of this support before we can objectively say we're going back into a bear market. Just to further hit home this point, let's say you're a stock market trader that has no idea what they're doing, and you bought the absolute high on February 2nd, even though that was a very overextended condition. You would have been a fool to buy at that level if you knew how to do technical analysis. But for the point of this story, let's just assume you bought that level. On SPY, you are currently only down 2.06%. So if you just look at who is getting hurt in this market, is it the bulls that have been buying this entire bull rally, or even the bulls that bought the very high on February 2nd that are currently only down 2%? Or is it the bears that continue to tell you this market is going to crash, that have been telling you the market was going to crash all the way back in December when we were getting this little bit of a pullback, then telling you we were going to crash this entire rally higher for the year of 2023, and continue to tell you the market is going to crash, even though we are in an objective bull trend, sitting above critical support, seeing low volume selling and high volume buying, and continue to put in higher lows and higher highs, including the weekly chart. So if you still think this is an objective bear market and an objective bear trend, then by all means, go ahead and continue to short this market. But if you want to be objective and you want to make money in this market, learn to manage your risk and trade in the direction of the trend. And right now, this is still a bull trend while SPY is above 404. Just think about the bulls that bought the absolute high of the year that are only down 2%. And think about all of the bears that are shorting the entire rally, and tell me which side of the trade do you think is more powerful and which side of the trade is currently being objective. So going into next week, you have very well defined support levels, and the critical resistance remains 414 and 417, and then above 417 we start marching higher towards 421, 425, and 427. On the NASDAQ 100 triple Qs, we were down 0.66% on Friday, and you could see the triple Qs are starting to lose this support trend line, and we did close right on top of the 13 EMA, and the critical support going into next week is going to be this neckline breakout, which is also the rising 20 daily moving average at 294. So zooming out here, we're talking about being an objective bull and why this is an objective bull trend. And on the triple Qs, we have this giant double bottom off of 260, which is a confirmed breakout above the neckline at 294, which means we do have a valid upside price target that should easily take us to 327 by early March. So what that means is you want to take on more risk as we approach this neckline, which is our critical support, because there's a good chance we are going to see a lot of high volume buying on our way towards that price target at 327 using the risk level at 294. So just to help you structure this trade, if you are taking a long position trade and that is your risk level, you need to manage your risk around that level, knowing that you have a price target of 327. And if you currently set your risk of about a 2.84% decline from that neckline, you have a 4-to-1 risk reward ratio as a bull with that price target, which means if you're willing to take on a 1.5x to 1 risk reward ratio, you can easily set your risk all the way down here at the gap fill, which is right around 273, and still have a favorable risk reward ratio. This is 100% technical analysis of a double bottom breakout, so this is a very valid trade setup, which allows the bulls to manage the risk very easily from that neckline breakout, knowing this is a very powerful macro double bottom breakout. Again, this all happened on increasing volume, which is the breakout that is going to cause this to continue to be impulsive. So do not look at this chart while the triple Qs are above 294 and see anything other than a giant double bottom breakout. I'm spending a lot of extra time going over this today because I want you to see why this is a bull trend, and I don't want you to just buy into the fear the market is going to crash, because technical analysis is saying the exact opposite. We're going to find out who is right very soon, but I'm telling you the charts are usually the ones that are right, and the people that are fearful and the people that are screaming the market is going to crash end up being the ones that are wrong. Come back to this video in a couple weeks and you can see if technical analysis was the winner, but I'm telling you more often than not, if you stay objective and you just take what the chart is giving you, you are going to have a very smooth ride in the market because it's going to be driven by risk management approaches. You're not going to be emotional because you have a trade plan and you know exactly the risk you're taking on with each and every trade you make. You know the critical risk level, which is the support level breakout at 294, and you know exactly how much money you're willing to risk or which direction you're willing to trade in. The chart is telling us to look for higher prices, so we are currently looking for support to hold and start marching higher from here. So watch that critical support at 294, and if that does break down, we have the 200 daily moving average right around 291 and this gap fill and rising 50 EMA right around 288. All of these are levels you can take on risk because above those levels, you have very well defined risk in this bull trend. And if we start losing all of that support, then you know we could be coming all the way down to the gap fill at 273. So let the price action tell you where we're going from here, but right now we have a bull trend with bullish price action while we're above critical support. If we start to bounce off support, you're looking for that critical resistance zone between 311 and 313, and then above that we're looking for our double bottom price target and our gap fill, which is in the 320s. On the Dow Jones, we were up 0.49% on Friday, so the Dow Jones is still holding within this bull flag, which we are expecting to break to the upside as we see the Dow Jones start marching back into the 350s. The reason we expect this to break to the upside is because it's a bullish consolidation, which means we had a very impulsive run higher, which is considered the flagpole. And now we're building out the flag on that pole, which is just consolidation as the bulls digest that last recent run up, and they're just resting, building up energy, getting ready for that next push higher. So as long as the Dow Jones is above, let's call it 332, this is a buy the dip in the Dow Jones, which will easily take us into the 350s. If we break out of the flag to the downside, the critical support will be the bottom of the flag right around 327. Upside resistance levels to pay attention to will be 343 and 346, and then above that we start marching higher towards 353 and higher. On the Russell 2000 IWM ETF, we were up 0.2% on Friday, and again we came down to the critical breakout level of the neckline at 188, and we did find buyers yet again, and we did see price action closing back over the rising 20 daily moving average. So going into next week, again you have very well defined risk as a bull because you have the bull trend, you have the well defined risk level at 188, and down here at the 50 EMA right around 185. And you know if we lose all of that support, we're coming down to fill the gap at 181. So you know your risk to the downside, and you know your reward to the upside, and you know we are in a bull trend, so you are looking to buy the dip off support while we have a bull trend. If we lose support at 188, that's a different story, and the bull trend will be looking a lot weaker. But right now, if we continue this balance, you're looking for the break above this resistance right around 193. And then we're looking to retest the previous high at 198 and then start marching higher into the 200. On the VIX, we were down 0.87% on Friday, and the VIX is back over 20 for 2 days in a row. So this is definitely telling you to be a little more cautious, because if we lose support in the indices and the VIX remains above 20, then we could start to see more volatility in the market and more panic selling. So watch the VIX closely, but if it starts crushing back down below 20, that should be a buy signal as fear is leaving the market and the bull trend is continuing. So let's just summarize all of this and jump back over the weekly chart of SPY. As long as SPY continues to close above 407 or on the daily chart that level at 404, we are looking over the next couple of weeks for SPY to start climbing higher towards 427. This is 100% objective, just following the trend. So make sure if you are still shorting this market, you are managing your risk very well, and you understand you do not want to continue to hold short positions while in a bull trend. If this bull trend rolls over and dies, then you can start shorting the market because it's going to be an objective bull trend breakdown, which means we should be resuming the bear market. We have no idea if the bear market's coming back because we don't see it in the chart, and we are strictly following and taking what the chart tells us, and right now the chart is telling us this is a bull trend. We have the bull breakout in SPY on the weekly chart, and on the triple Qs, we have a giant double bottom that has not yet met the price target. So stay objective and manage your risks no matter what you're doing, because you never want to blow up your account just because you're on the wrong side of the trade. If you take a loss, you take a loss and you learn from it, and then you try to understand what you did wrong and you continue to grow as a trader. Also, don't forget I have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETFs TQQQ and SQQQ and sends you all of your buy and sell alerts directly via email and text message. You can learn more about Bank or learn how to subscribe by clicking on the link in the description of this video. If you want access to all of my intraday updates and analysis and my members-only videos, come join us over at the Stocks Channel Trading Discord community. You can find out how to join the Stocks Channel Discord by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.